The Swiss National Bank is about to choose their interest rate. Consensus is for a 25 basis point cut. Traders are ready for a 25 basis point cut. The market is ready for a 25 basis point cut. Everyone is expecting that 25 basis point cut. With that said, the Swiss National Bank twists the plot like in a Nolan's movie and they cut 50 basis point instead.
Usual, you delivered quite a large rate cut. You went for a cut by 50 basis points, whereas most economists had expected 25 basis points, only a quarter point move. Can you walk us through why did you opt for this larger move?
So in September, we hinted or we said that further policy easing might be necessary to ensure price stability in the medium term. And now we saw in the last quarter that inflation prints were below our expectations, and also the inflation pressure in the medium term was lower, and this led to the decision that we do this rate cut today.
So, this is where it gets interesting because let's see what's going on. First of all, obviously, the Swiss franc drops quickly on that. Rate cuts are bearish, and if the market is priced for a 25 basis point cut, but the central bank cuts 50 basis points, that's a double surprise. So, in this type of situation, with just this single piece of information, what do you think USD Swiss franc should do next? So we're looking at the dollar compared against the Swiss franc. Now, don't mind about the dollar side bit, but focus purely on the Swiss franc part. The Swiss National Bank just surprised the market expectations by cutting twice as big as expected. In other words, what happened here is the central bank, the Swiss National Bank, moved in a way that was not priced in, not expected. The market, economists, and wherever else were expecting a 25 basis point cut. Instead, the S&P surprised with a 50. Okay, why is this important? And most of all, why is this tradable? Simply, this creates a new, fresh sentiment that the market needs to adjust for. A new scenario, a new context that needs to be priced in. So imagine it like this. First, there is a lot of funds that are now interested in positioning after the event. The Swiss National Bank is more dovish than anticipated. Let's show the Swiss franc. And that's one side of the story already. And second, there are now traders positioned on the wrong side of the fundamental context that now have to bail out of the trades. They either were expecting only a 25 basis point cut, maybe they were expecting a no cut, whatever. Now they've been surprised on the wrong side of the market with that 50 basis point cut, and now they have to square and liquidate their positions. So obviously a lot of this happens quickly, very quickly, with a quick market reaction. But that's not enough in this scenario because yes, the market is made up of very fast algos and some very fast intraday traders, but there's also slower and bigger funds that take hours to catch up with the flow. They have to analyze, they have to evaluate risk, they have to comply with too many different checks and evaluations, and so often they don't react right away. And on top of that, think about how the world is structured, Not all sessions are active all the time. So something that happens at the London Open, it will arrive to New York traders only hours later after they wake up. So when the market gets surprised by something not priced in, like in this example with the Swiss National Bank, there's often a short-term and potentially even longer-term trade to take here, because it takes time for the market to properly adjust to the new scenario. So again, where do you think USD Swiss franc should head now? It should go higher because the Swiss National Bank just cut twice as expected, as explained. The market was not priced in for that. Traders were not expecting that, and so that would create what we just talked about. Some traders react quickly, of course, and other traders instead take some time. And there you go. You've got a tradable trend out of a fundamental event like a central bank interest rate decision. Again, what matters here is that the event surprised market expectations. That's the key element that creates this type of short-term momentum flows. Now, obviously, these don't happen very often. Central banks don't always like to surprise market expectations, but it happens. And so it's another tool, fundamental knowledge to add up to all the rest. And obviously also this logic does not happen only with central banks, of course. This is true with fundamental data too. For instance, it's January 7, 2025, so after the Swiss National Bank 50 basis point cuts. The Swiss CPI now is about to be released, We know the S&P is very reactive to downside misses in inflation. I mean, it just cut 50 basis points, twice as expected at their December meeting, as we just saw. That's a clear indication that they have no tolerance for lower inflation, and rightfully so, because the core yearly reading in Switzerland is sitting at 0.9%. Yearly reading, not monthly. That's a very low number and quite close to deflationary territory. So any small downside surprise here is likely, highly likely, to trigger a fresh wave of Swiss franc selling, as the market would need to price in more rate cuts from the Swiss National Bank ahead. So the inflation numbers get released, and there you go. Swiss CPI, Swiss core CPI, expected at 0.8, prints at 0.7. Not only printed below expectations, but it also printed quite below from previous 0.9. Switzerland is getting closer and closer to deflationary territory. We know the Swiss National Bank will not like that. So, what do you think the next move for the Swiss franc is? It should weaken because it should price in more rate cuts from the Swiss National Bank. And so in this case, USD Swiss franc should move higher. And again, the point here is the trend. Yes, we got a very short-term reaction, but the real opportunity here is in the second wave of flows, the one that happens after the first reaction. That's the tradable part. So the key here is to identify the surprises in market expectations that mean so much that they require traders, funds, market expectations, all of them to readjust over time in another direction. And this creates this type of trends out of a fundamental event, whether that's the central bank surprising expectations or a key economic data surprising expectations. That's what creates an opportunity out of a fundamental event, like a central bank interest rate decisions or an economic data.